We are live from the JP Morgan India Investor Summit, and just the perfect guest to get on the day after or on the day when China's unveiled some stimulus measures. James Sullivan, Head of APAC Equity Research at JP Morgan, with us. James, it's been a really long time. Good talking to you.
Thank you for having me.
And thanks for having us at your conference. Wondering what's been the most common thing that has been asked, not just in the yesterday, but now this morning as well, considering that Fed easing has begun, but China has also unveiled some stimulus measures.
No, thank you for that. Look, I think the most common question that we continue to get from investors, not just today, but for the past 2 years really, has been what is the incremental driver of performance in a market that has outperformed, that does look relatively expensive? And I think the critical conversation, at least from my perspective, and we talk about this a lot at JP Morgan, is the degree to which both economic as well as market performance here in India has really been a DIY project. From an economics perspective, you've seen Indian government as well as Indian corporates really take the lead from a CapEx perspective. You have not yet seen an incremental influx of FDI, particularly from a supply chain relocation perspective. So that's an incremental positive driver that is yet to occur. From a market performance perspective, you've seen very strong earnings growth, which is starting to wane a little bit. So we're being selective with sector and stock selection right now. But you've seen economic growth that's been driving earnings growth. You've seen fund flow that's been almost entirely domestic in nature. And again, from an incremental performance perspective, there's two stories to tell. Number one, Indian household participation in the Indian equity market only sits at about 5%. That's low by emerging market standards and offers significant upside as more Indians invest in the domestic stock exchange. And from a foreign investor perspective, JP Morgan estimates that about $100 billion has to come into this market just for offshore investors to get to neutral. Now, every month that the market performs, that's more and more index drag on offshore portfolios. To put that number into context, again, $100 billion US dollars in incremental inflow. Year to date, we've only seen about $10 billion. So 10 times the year to date fund flow just to get to neutral. Now, we need to be careful what sectors and stocks we put that into, given divergence of economic growth, but we still see very strong prospects for outperformance moving forward.
So let me start with the last point first, which is flows. For the last so many quarters, maybe global investors are putting money through the primary market route, but secondary markets have largely been devoid of incremental flows.
Correct.
Do you reckon this positioning to neutral, and therefore whether it's 90 or 70 or $60 billion or can come in with markets sitting at the levels and the valuations that the Indian markets are?
No, great question. In two ways to look at it. From a fund manager perspective, your index drag is getting worse and worse as the Indian market continues to outperform. And as the market performs, India as a percent of regional indices continues to expand as well. So again, that's it's a flywheel that's going the wrong way for a lot of offshore investors. And eventually you have to take the view either that the market has to go down significantly or you have to start to neutralize those underweights. We expect the latter, not the former, for a variety of different reasons. From a asset allocation perspective, again, shocking for a guy that runs a team of bottom-up company analysts, we think it's all about stock and sector selection. In particular, given the market outperformance that we've seen, incremental investments have to be targeted at specific sectors. One thing that we've seen from regional investors for really the last couple of years has been listening to government policy. That's been relatively effective in a market like China. It's been relatively effective in a market like India. So incremental government CapEx in infrastructure, particularly as it seeks to encourage offshore investors, that FDI that has yet to occur, to start to come into India. That's a sector that we're relatively positive on. I can't find an area of Mumbai that's not under construction right now. So clearly there's incremental demand there. If you look at electronic manufacturing, if you look at the defense industry, as India seeks to reorganize its suppliers in that space, we see very, very strong idiosyncratic bottoms-up stories that can continue to drive selective outperformance.
There is physical, speaking of infrastructure, there is physical infrastructure, energy infrastructure, digital infrastructure, all getting built in a very big way in India, primarily through government CapEx maybe, but private starting to come in. Which part of infrastructure are you more constructive?
So just on the investment perspective, I think it's critical to identify three incremental drivers. Number one is government. Number two is Indian corporates themselves. Number three would be FDI coming in from offshore. What we've actually seen is not just the first pillar. Government expenditure has been strong, and market reaction to that has actually been quite positive relative to other markets around the region.
Right.
Investors are very clearly voting with their pocketbooks that they believe that the efficacy of India government CapEx is reasonably strong. And that's not the case in some regional markets. And so that's an important differentiator here in India. Indian corporate CapEx has actually been pretty good. And so it's really been the third leg of the stool that has yet to come through in a big way, which incrementally we expect to start to see off the back of infrastructure spend from the government.
Okay, you do start to see, because one of the other pushbacks that some people have said that for private capex to come in, keep an eye on China, because if China were to face tariffs, if there is a Trump presidency, let's say, right, then China dumps goods across the Asian region in a meaningful way. And all those sectors might see pushback of capex plans, because there will be a final goods deflation scenario that we see. How do you think about this?
So it's a really good question. I think there's at least two angles to the answer. Angle number one is, if I look at most global multinationals, is there a geopolitical angle to the China conversation? Of course there is. Is there a broader risk conversation in that many multinationals understood that they became too indexed to one particular country and one particular supply chain? And are they looking to diversify that just for risk mitigation? Nothing to do with geopolitics. That's a separate and important, but separate conversation, right? So just from a risk mitigation perspective, you're seeing supply chain diversification because people had gone too all in on one link, and that's not good business. And so you're starting to see that diversification occur regardless of what happens with geopolitics.
This started post-COVID,
Correct.
Right.
The comment that you made regarding the potential for China to start to aggressively export to different countries around the region, I think is a fascinating one, because effectively what we're saying is China's ability to export to the West in particular industries, let's say electronic vehicles as an example, is starting to change. And so one of the fundamental geopolitical conversations that we're trying to have internally at JP Morgan, what does that mean? Potentially quite a lot, because you potentially create different trading blocks. You potentially have differential macroeconomic variables at play within those differential trading blocks. Excuse me. And from a big picture perspective, China has been exporting deflation around the world for many years, right, as the exporter of choice. If that deflation is no longer being exported to the West, that's higher inflation in the West and more deflation in the rest of the world. And so that's something we're trying to understand. It's a very, very large structural change to the way the global economy will work.
Wow. And what are the investing implications of something like this, James?
We have to think very carefully about the implication for rates. We have to think very carefully for the implication for currencies. The beauty of the India story right now, particularly from a rate and currency perspective, again, go back to the top of the most important theme. This has been a DIY conversation here in India. The RBI currently has $700 billion in FX reserves. It has a more independent path forward in rates than most other Asian economies, which is interesting.
Yeah, it does. I mean, some levers that the Indian bank has vis-a-vis some of the other countries, which is, I think, some of your colleagues yesterday were telling us that the Reserve Bank can choose when it wants to cut rates. It doesn't have to necessarily follow the Fed, if you will.
Sounds like a great comment, which probably means it was Sajid Chinoy, who's our chief Indian economist, who's extremely good. I mean, look, I agree with where he's coming from. And again, it all comes back to this DIY concept that India is in control of its own destiny in a way that not many economies in Asia are.
Yeah, that's true. Okay, the other aspect that you mentioned, manufacturing. And I mean, the defense and electronics are the poster boys. Maybe the stocks have run up too much. Some of them have corrected. Is there something else out there? Because there's a lot of other manufacturing attempts being made in a meaningful way. Is there something else that you like, bottom up, if you will?
So we're watching very closely the overall infrastructure sector, construction, electronics manufacturing, as you say. And that's really interesting because you've seen some very strong headlines in that space. So Apple's starting to relocate some of its assembly here to India. But again, the FDI numbers have not seen that flow through in any meaningful way. And so incrementally, we're watching that very closely and talking with a lot of the companies that we cover outside of India to understand their incremental CapEx plans.
Got it. Okay. What is it that worries you about India? It seems a promising story. Your colleagues were telling us 33% higher participation. Out here, if you are here, you can feel the excitement around India's story. Where is the worry?
So I'd say there's two elements to the answer, at least. There's always multiples, but two elements in this case. Number one, policy continuance. And so one of the stories here in India for the past couple of years now has been a relatively strong central government pushing a very clear and direct public policy stance. And if you look at Aadhaar, if you look at direct payments to Indian citizens, those have driven very different outcomes, and the market has recognized that. And again, one thing that we spend a lot of time thinking about is what is the market saying about different elements of government policy? I referenced this earlier in the conversation. What the markets are saying is that investors are very comfortable with deficit spending here in India. They're comfortable that there is efficacy to that spending. That is not the case in other regional markets, which is interesting. if you start to get any major shifts in government policy, if you start to see the policy platform changing in a meaningful way, or just a reduction in the power of the center, that results in forecasting risk, and that has to get priced in.
Okay, what's the other? So what is policy? Is there something else that worries you?
I think the other element that will be very interesting to watch, particularly off the back of the most recent election, national election here in India, is the degree to which you see the central government push more income redistributive policies. Sajid talks a lot, Sajid Chinney, our chief Indian economist, talks a lot about this concept of a K-shaped recovery. Other folks have mentioned it as well. The top bar of the K has done extremely well. And so folks like yourself, they're very wealthy and well off, have done very, very well. The bottom half of the K, less so. And so what we're starting to see off the back of the recent election is more and more policy attention to the bottom half of the K. That's very positive from a broader macroeconomic growth perspective, and very positive, particularly for the consumption space, which incrementally we're watching very closely.
So you're not quite constructive there yet. You're watching it, and you might turn constructive if indeed it finds more feet, is what you're saying?
We'd like to see more flow through into consumption spend. The beauty of that conversation is the incremental propensity to spend for lower income households is significantly higher than higher income households. And so if you do see income redistributive policies start to push funds into the lower part of the K, mathematically, you should very clearly expect more spend, which would be positive for the consumption space overall.
Great. Last question. Within the Asia Pacific region, where is it that what's the pecking order? Where is it that you're more constructive on? I'm not asking for 1, 2, 3, but maybe let's say the top 3 and the bottom 3, if you will.
So we're starting to see investors start to get more serious about looking into putting capital to risk in China, which is interesting. Many investors have been doing a lot of work. We had our China summit in Shanghai in June. Very, very strong investor participation. A lot of people doing the work, but not yet pulling the trigger in terms of making those investments. We're starting to see that at a sector level in China, and that's something that we're watching very closely. Across the ASEAN space, we had our investor summit in Indonesia recently in Jakarta. Very, very interesting stories coming out of that market. Critical, however, will be to see how the incoming administration starts to structure public policy, in particular on the fiscal side.
Okay, and lastly, this China stimulus news that has come up, is it too little or is it meaningful enough for you to take note?
What most investors have done in China really for the past 2 years is increasingly wait for the data, not just put all their faith in the announcement. And so watching the flow through of those announcements into underlying macroeconomic data, into property sales, into consumption expenditure will be absolutely critical.
Great. Okay. James, such a pleasure talking to you. It's been a while, but thank you so much for speaking to us.
Thank you for having me.
The pleasure was ours, and viewers, thanks for tuning in.